Hey everyone, welcome back to the Commercial Real Estate Library Podcast. I'm Dayma and you know my co-host Garret McGillivray, and joining us today is the CEO of Minto, Michael Waters. Thanks for joining us.
Yeah, thanks for having me.
I'm gonna read this so that I don't butcher it. I'm gonna do the fast version, but a little background on Michael, and I love the last name Waters, by the way. Michael has spearheaded the transformation and growth of Mento from a wholly owned family venture into a world-class, fully integrated real estate investment management company. In his role, Michael oversees all aspects of business from corporate services to asset management, acquisitions, dispositions, development, property operations, and home building in Canada and the US for Minto's growing portfolio. He joined in 2007 as the CFO. I'm going to skip ahead of a bunch of interesting stuff here. But you went to Wharton. You're the first CEO, non-family member CEO in the company's history. It's a 70-year-old, 7-decade-old company, which you just do not see today. So really impressive. I'm excited to hear about the story, and we're going to dive into what's happening in multifamily development, how Minto views the market, strategy, and what's going on in your day-to-day.
Yeah, looking forward to it. Should be good.
Yeah, awesome. I think a good place to start would be how did you get into Minto? What did it look like at the time back in 2007? Take us to the beginnings.
So I joined in 2007. I had left IntraWest, which was a resort operator developer, which had been taken private the year before by a New York-based hedge fund. And so I was joining what had been a public company taken over by a very sophisticated New York-based hedge fund into a family-owned and family-run business that had been very successful for 50 plus years, but was going through a transition. And the transition being the Greenberg family, who had founded the business and owned it, had made the decision that they wanted to continue to own the business, but they wanted to transition to non-family management. And so I was one of a number of executives that was hired around that time,
right?
And then began that process of taking the company into its sort of next stage of its evolution. Yeah. And so it's been quite a journey.
Yeah. Can I ask because there's a lot of, we mentioned before we started, our audience is brokers, director of investments, CEOs. We kind of span the gamut of real estate professionals. And then, of course, a lot of young people just looking to learn, which is great. But some of the audience has that family business, right? They might have right now 500 units or something like this. Or maybe they're trying to cross the boundary between, getting into public money, having a better engine. Like, what does that transition look like?
Yeah, it's a big switch. When I joined Minto, it was, its growth had been financed entirely on its own balance sheet. So from its own earnings, plowing that back in the business. And one of the things that, Minto's leaders at that point were looking for was to be able to leverage third-party capital to fuel the growth. Simply speaking, they had ambitions to grow the business that outstripped their own balance sheet capacity. And so, one of the things I had a fair bit of experience in my pre-Minto days was raising institutional capital for development. And so, when I came in, we embarked on that process. And when you think about becoming a fiduciary for other people's money, that's a significant step. It's a change in mindset.
Yes.
You have to put your investors' interests before your own to be a true fiduciary. And it also means that you've got to have the building blocks in place to do that. And I'm talking about the plumbing behind reporting and budgeting and IT systems and a lot of that kind of stuff that underpins a successful platform. But you also have to build that culture within your management team to think like a fiduciary and begin doing those kinds of things that investors are looking for. And so it's a multi-year process, I would say. This is not a quick fix. This is not something, there's no silver bullet to do this overnight. It takes time, and time measured in years, really, to make the kinds of investments that you need in talent and systems and processes in order to make that transition successfully.
And we have, as of today, I think, Minto has about 1,300 employees. And what did it look like in 2007?
So, the company was very much a family-run business. And like many family businesses over the decades, at that point, over 50 years of history, the guts of the business, the very core, the origin story was as a home builder and building apartments. Over the span of decades, the company had migrated into a lot of different asset classes. So we're industrial, hospitality, retail, office. And so one of the things that, when I became CEO a couple years later, we really focused on was, focus and really getting ourselves, because I'm a big believer in focus, and you can't be fantastic in everything all at once.
Right.
And I, what I really felt was important for us was to really concentrate our efforts in the area where we had a core differentiator, something that made us separate from competition. And so in our world, in my thinking at that time, was to focus on residential and mixed use development. So we really worked hard to exit industrial, office, retail, hospitality, and focus on our core competency, which was developing land for residential, building homes, building condos, and building and managing apartment buildings. And so, that when I joined, we were still very much pre-focus, I'll say.
Yeah.
Maybe that's as a way of saying it. And we spent the next several years really working through that. And so the business has changed a great deal from when I joined. We had to reorganize how we were structured internally. We had to change our systems environment entirely. We had to bring in new reporting and financial management systems to accommodate that kind of growth. So it's been a process.
It is a extremely difficult task to the focus that you talk about, because that's what every young CEO would grapple with, or every young business person a lot of the time. Where do you allocate your time and energy? Because you could basically do anything. You just can't do everything super, super well.
Correct. I mean, you think about elite athletes and their training, or certainly leaders in other fields. To truly reach that elite level of success requires a single-minded kind of level of focus on the preparation. And so, I tried to bring that level of focus to what we were trying to do. And it meant stripping away a lot of distractions, sometimes it's addition by subtraction.
Right.
Getting rid of distractions naturally brings a level of focus.
Yeah.
Part of the trickiest part of transition is culture change. And every organization, every team has a culture, bar none. The question is, did you choose that culture? Is it a culture of one that has been implemented by choice and forethought, or is it a culture by accident? And is that the culture that you want to have guide your organization or your team? And so, really thinking hard about culture and the kinds of things that you need to do to bring that right kind of culture that's going to guide you to success, right?
Yeah.
Those are important things. And again, measured in years, not weeks or months.
How were you able to change the culture as you came in?
So I think the environment when I joined, like many family businesses, this isn't just real estate, but real estate is emblematic. When it's family owned and family run, oftentimes you're dealing with, if it's not the founding generation, it might be the second or third generation. And there is a deep reverence for, the origin story for the family that founded the business, the entrepreneurs that founded it and got it to where it got. Often when you get into later stages, there is a deference, such a level of deference to the founders that, that second and third generation is fearful of making change that might break the china. That,
right.
Where the founders, my uncle built that building, or, my dad was instrumental in this decision. How dare I presume to sell that asset or to change this thing? So, and moreover, as the family business grows, the management team, I often think of a hub and spoke. Family members are often the center of it and in decision making and those kinds of things. And often some of the skills that you would expect to see maybe atrophy a little bit. So when we went through the transition from family run, we had to make a bunch of culture change decisions. And part of that involved, really hard thinking around talent management and how we thought about talent, who we were recruiting and hiring, who we were promoting, the kinds of training we were giving our leaders, compensation, and particularly in a private environment, you don't have some of the same tools you would have in a public company environment. So, and in a family-owned and family-run business, your suite of tools might be even more limited. So you have to think of ways of generating alignment, retention, but also incentivizing for success and driving for success. And so, I would say that our family shareholder group has been unbelievably supportive as we went through this process of making some of these difficult changes to make that culture change and some of the changes to the platform to allow us to reach that next level. And that's critical. Without that support, it would be dead in the water.
You have to give a lot of credit to a family who is already crushing it and then goes, all right, let's bring this to the next level. It takes some guts to do that because you honestly don't need to. You're fine. Complacency was definitely not something that they suffered from. They were anxious to keep going to that next level. And I think had a level of humility that allowed them to bring in some change. And one of the key steps that the Greenberg family brought in was they brought in a public company style governance model. So in 2008, less than a year after I joined, they brought in a board, a fiduciary board, not an advisory board. And there's a big difference between those. A true fiduciary board with a majority of independents that served on that board. And they effectively assumed the oversight of the business, of management for the shareholder group. And because they were a majority of independents and they were executives with significant stature, and they weren't friends and family. These weren't golfing buddies or hockey buddies that the Greenbergs knew. These were folks that they went out and searched for and selected based on the merits of their track record, their experience. And they came in and really helped implement some of that change that we needed because they provided a degree of oversight and direction to the management team that helped foster some of the change that we needed to make. And really, I'm a huge believer in transparency. And with the board there, transparency is the ultimate. You always talk about sunlight as being the ultimate in terms of addressing problems. So exposing things to the sunlight is an incredibly important process as you're making change happen, right? Right.
And the board was the tool to make that happen.
I left this part out, but I should have said this at the outset. So Minto, big multifamily player, both in development and in just ownership generally. You guys have amazing properties. And property management too. You guys have that arm as well. I've been inside your, I think it's Lakeshore and Bathurst. Yeah. I used to live right around the corner from there. Amazing building. Love the pools. And so I should mention, Minto has approximately 10,000 units or so, and have built about 100,000 over, in the U.S. and Canada. Is that correct?
Well, we built 100,000 homes for sale.
Right.
On top of that, we built 20,000 plus apartments. So, and we have a publicly traded REIT, of which we have a 42% stake. That REIT holds about 8,000 of those units. So, so it is a significant player. Certainly not the largest in Canada. There are many larger, but a significant player. And I think maybe a differentiator was that we historically had started as a developer and then grew the platform from there, as opposed to simply growth through acquisition. So
right.
A lot of the assets that we own and manage would be assets that we would have developed ourselves as well.
Like some of the other greats, like Homestead and some of these.
Certainly,
these
there's
folks.
some fantastic players in the industry that we look to for inspiration. Homestead certainly would be one of them. So
yeah. Talk about a family business.
Crazy story. Britt Smith's absolute icon. Homestead is the team, Alf Hendry and the larger group there. We have a ton of respect for them and what they've done over the years, and tremendous growth. And as a developer or constructor or manager, really in many ways unparalleled, but not really well known outside the industry. Certainly they would have the scope and scale that they should be, but very quiet and certainly well deserving of the respect that they get.
Yeah, exactly. They have a certain way that they do things. So. Okay, I want to dive into the market.
Yeah.
So first, if you could provide a backdrop of, I mentioned 100,000 homes built, you mentioned 20,000 apartment units constructed and the REIT. Can you talk about the locations that you guys are in? And then we're going to use that to then dive into how you're viewing the market, both multifamily and development.
Yeah, so we look at the housing market in Canada holistically. So we do think about for sale and for rent. They are two halves of a coin. And often market conditions are such that, one side is relatively stronger than the other, but they do act on each other, right? Housing affordability is a function of both the rental market and the housing ownership market. Mm-hmm. When I think about, our business, from the multifamily rental side, we've tried to focus on larger markets, and I would say, generally speaking, the emphasis has been on more urban settings,
right.
As opposed to suburban settings, and we have been able to grow in markets like Vancouver and Victoria, Calgary, Ottawa, Toronto, Montreal, in part through development to a large extent, but also we have acquired assets. We've also converted properties, whether it's hotels, we've converted into multifamily, seniors, older seniors buildings that have reached end of life from a senior's perspective. We're
recently
converting. Yeah, exactly. Yeah. So we're doing one right now in Mississauga. So we've grown through multiple, I say means, and again, really focus on kind of more large housing markets, mm-hmm. and particularly urban sort of settings. That's been our focus.
We mentioned Vancouver, Victoria, Toronto, Ottawa. You guys are in the U.S. as well, right?
Correct.
And how are you viewing? We'll talk about multifamily first before development. But how are you viewing the multifamily market? Interest rates are all over the place, but down since the beginning of the year. We've seen some of the institutional investors take a little bit of a step back from value add. Cap rates are up a little bit. The private investor has really come out to play. We have out of the 8 deals that I have under contract, 7 of them are with private investors, and these are larger acquisitions as well. How are you thinking about that space for just general multifamily? Do you guys, is there any appetite to acquire today existing? Is it more a focus on development? How do you make that determination?
I'll be careful to draw a distinction between Minto Apartment REIT, which is the principal vehicle through which we hold core and core plus multifamily assets. And the REIT market, public REIT market in Canada over the last 4 years has gone through a series of convulsive shocks, I'll call it, starting with the pandemic and the deurbanization theme that sort of developed in that. But then, obviously going through the monetary policy response, flooding the economy with cheap money, and then
What a
the
time to be
inevitable
alive.
exactly. And then we had some inflation, obviously inevitable, and then very, probably the most violent monetary rate tightening cycle I'd lived through. And through that, what we've seen is that the public REIT markets, particularly for multifamily, have really been impacted. We'd seen, in effect, the ability to raise capital through follow-on deals very, very constricted for the last 4 years, I would say. And so we've seen, publicly traded REITs, and this is, to your point, with the majority of the acquisition transaction activity that you've seen from a buying perspective been privates. I mean, the public REITs have really been limited to, harvesting capital, redeploying capital through asset sales to buy new stuff if they've been able to buy it all. And the level of transaction activity has been muted as a consequence. And part of it is the public markets focus has really shifted. If you looked at it in the late 2019, 2020, the focus was very much on NAV growth, growing NAV. That was the emphasis. Through the COVID crisis and the cap rate expansion that followed with the volatility in bond rates and is that we saw the focus change to cash flow growth, and that emphasis became critical. And so looking at cash flow accretion or dilution in evaluating an acquisition and what would be the market reaction to an acquisition when we were seeing REITs trading at significant discounts to NAV became quite problematic. And I would say we're starting to emerge from that. We've seen over the last couple weeks, couple REIT IPOs. We've seen Starlight announce a deal for a core multifamily fund. We're starting to see, I'd say, some beginning signs of an interest in the multifamily sector that has been dormant for quite a while, trading at massive discounts to NAV. And I think maybe there's a dawning awareness of that discount is just too big. It's too good to be true. Maybe we should reevaluate. I think there was, I talked about convulsive shocks earlier. Another one was the change in immigration policy. Between 2016 and let's say 2022, we were, as a country, growing at a furious pace, population growth wise. At one year, over 1.3 million people.
Yeah.
And without the corresponding changes to housing policy, education, healthcare to accommodate that kind of population growth. And we saw predictably, rents grow very rapidly. Then the immigration policy reversal, a very abrupt reversal in 2024. And I think, you saw the REIT sector had a early sort of signs of what looked to be a recovery in the late summer of 2024. That quickly reversed with the immigration policy change or that announcement. And I think probably the REIT sector was oversold as a consequence. Now enough time has passed that, I'm hoping the market is looking at it and saying, geez, we've survived somehow miraculously and REITs continue to grow cash flow. And I think there's starting to be more private market transactions that are supporting the assessment of NAV.
Yeah.
Because for the longest time, there was an absence of transactions. You couldn't really say concretely what the cap rate was. There just weren't enough comparable transactions. So that's starting to change. And I'm optimistic that, maybe we're coming out the light at the end of the tunnel there.
What was interesting too, we would be advising some sellers in secondary and tertiary markets, and they're like, well, my cap rate's still here. And you'd say, okay, look, in Toronto, there's less transaction volume, but there's still volume, right? So you can look, and a buyer's going to look and say, hey, that transacted at a 4.25, so it's no longer a 3.9 or whatever. So there's the market. And so that's where your bids come in sometimes, right? if you're up in Thunder Bay or, Windsor or wherever, there just haven't been enough deals, right? And so like it's unclear where the cap rate is. So that like it's kind of, in some respects, the cap rate actually moves slower in those markets than it did in Toronto, Ottawa, and so on. But you brought up a good point about there's starting to be more interest. Can you talk a little bit about that InterRent acquisition? It was big headline news. I wish I had the full story here, but like, how do you think about that? If you can describe that a little bit and what it might imply for the market.
I think it was probably not a shocking surprise to market observers that it was announced. Certainly, it had been rumored and it was in the press in the early part of March, so it was sort of out there, so to speak. I think it's reflective of the fact that it was such a quality company. InterRent was long a leader in the multifamily space in terms of NOI and cash flow growth. I mean, they had an incredible run of unbelievable success from an operating platform perspective. And to see that great company and its portfolio trade at such a steep discount for such a prolonged period of time was really quite incredible. And I think, the transaction that has arisen as a result of that is probably a reflection of the frustration that some of the principals have with how enduring that is. And what we're seeing in the private market, frankly, I think is leading where the public market's at. They are large, savvy institutional investors that are seeing the value in a stock like that and the portfolio and the operating platform and saying, this is just too good to be true. And I think in hindsight, people will look back and say, that was an absolute steal.
Yeah.
Priced it at $13.55. I would say, there's the consensus Bay Street NAV that would be around 14 or something like that. But,
sorry, what was the total size of the deal? I should know this, but I forget.
Yeah, I don't have the total size off the top of my head, but it would be, certainly $4 billion-ish, let's say, of enterprise value. So a sizable transaction, but certainly, the five big multifamily REITs, they would be probably the fourth and we would be the fifth, let's say.
Right.
So certainly not the largest multifamily REIT in the country, but one, as I say, that had a long track record of really punching above its weight from an NOI and cash flow growth. And Mike McGann and Brad Cutsey and that team, they're very, very well regarded by investors for their ability, particularly on the value add side. What they were doing was really tremendous. And so I think what we've got is a savvy institutional investors look at this and say, geez, here's an opportunity to partner with the principal of this and of this company and buy it at an incredible discount and see where we can take this platform. And this is an institutional investor with a lot of conviction, right? They previously made a very significant foray into Canada in the industrial space.
Like a Singapore
sovereign fund, So I think, what it's done in the sector is I think it's probably wakened the institutional investor space a little bit around the opportunity there. And you forget what you had until it's gone, kind of thing. And they see a great stock like that, trading at that kind of discount. And certainly, an institution like that on the private side coming in, probably leading the public market. So I think it's possibly a harbinger of things to come. I think certainly it is one of the forces that's probably pushing some of that optimism around the sector.
Right.
So, yeah.
I will find them, but I would love to do a deal with the, Saudi Arabian. I would like to do a live golf style deal.
Yeah.
That would be
Saudi prince.
That would be the dream. Yeah. So, and exciting times ahead. So we'll see.
Very exciting.
The largest deal that I've done, there'll be a larger one this year, but the largest deal so far, 200 million. So it'd be nice to kind of ratchet that up 20x.
There you go.
That would be cool.
There you go.
You know what? We should dive into development. So, and again, we have the opportunity to chat about this because you got public vehicles, private vehicles. And one thing that I remember hearing from Mark Kenny, or it might have been somebody else, but it's tricky, as you mentioned, for the analysts now to value development, right? And, it used to be net asset value versus cash flow. And so now you're not getting rewarded as much for chasing those developments, at least in the public markets, even though you're adding a tremendous amount of value. So like, how do you think about development these days? And I think you guys just bought something up in, was it Oshawa or something, some $100 million acquisition. Like, what's your guys' strategy on the development side?
Well, I think you pointed out an important
Sorry, by the way, I know I asked like 8 questions there.
That's okay. We'll try and tease those out. Let me deal with the first one, which is development in a public markets perspective. I think, in the REIT structure that we have development, development is cash flow dilutive during the development period. And it also is adding a significant amount of leverage, right? And smaller REITs in particular have less appetite or less capacity, maybe a better word, to do a lot of development on balance sheet because of that cash flow dilution, because of the leverage impact. And so, and even for larger REITs, I would say development on balance sheet has probably become less attractive. Certainly there are some of the peers in the multifamily space like Killam who've done a fantastic job as a developer and have done, very credible work there. But I would say just so broadly speaking, probably less appetite for development in the public sphere. But on the private side, what we saw over the last couple of years certainly was a surge of rental housing starts and deliveries. And I've talked about early in this conversation about the linkage between new home and for rent, and they are very linked. And I'll say particularly for large urban markets like Toronto or Vancouver, where there is a significant, or traditionally has been a significant condo market. And that condo market was comprised in no small part by investor buyers buying on a pre-construction basis to buy an investment unit that they were going to put into the rental market.
Right.
And what we've seen over the last couple of years is that condo market, certainly in Toronto and Vancouver, but broadly speaking across the country, has really suffered. And certainly we're living through perhaps one of the most significant corrections in the condo market. We are still delivering, let's say, the backlog that was sold in 2020, 2021, and maybe the very first part of 2022. But as that pre-construction sales have basically disappeared and that backlog delivers and will deliver through 25 and the first 6 months of 2026, we're going to see deliveries of condos drop right off the cliff. And condos are a significant, particularly investor-held, significant component of the rental housing market. For years, Canada wasn't building purpose-built rental because of tax laws, because of the condo sector, which was just more appealing as a developer. So how we were delivering rentals was in the form of condos. And so as the condo market over the last couple of years has really suffered, and I think we're seeing starts fall, and we've seen condos
fall off a cliff.
Exactly. I mean, it's collapse, right? But what we saw sort of in parallel with that, or maybe at the same time as that was coming down, we were seeing a surge in new rentals happening. And part of it was fueled by policy change. We saw the change in GST for new purpose-built rentals. And we saw some other things happening. Then, of course, we had the immigration policy change in 2024, which kind of put things a little bit of a chill on things. I think that we'll see new starts of purpose-built rental probably settle a little bit. Certainly, when you look at the urban land market in larger urban centers today, land values still, are being held at sort of relatively elevated levels, let's say. It hasn't fully corrected, very few transactions. And sometimes the math is still kind of hard to make it pencil. I mean, there are deals that are starting. Certainly we're starting some, but a lot of it's on legacy land where we've been able to make the numbers work out. I think what we're seeing now is an adjustment as well certainly in the high-rise concrete construction sector, as those condo starts have really petered out. And you can look at the skyline, the room we're in right now. What we would have seen out of this, gorgeous boardroom would have been cranes, a sea of cranes on the skyline. And now if you look out in an urban center like Toronto, there are very, very few cranes. And the cranes that you see are typically ICI related. They're not necessarily residential. And so we're seeing construction costs really sort of adjust back. In some divisions of your hard cost, pro forma, you're seeing going back to 2019 pricing, or because we saw through the pandemic inflation on the construction costs that just soared. It's come back down or coming down in some areas. And so I think that will help counter the effect of some of the other stuff that was sort of working against us. But that surge that we saw in rental housing, as I say, probably come off a little bit, but I think it's we're going to see more of it, and I'm optimistic about it.
Me too. So I guess what you're saying is by early 2026, less rental being developed, virtually no condos coming to completion.
Yeah.
That sounds like a bull run scenario.
It's fantastic if you're a provider or you've got deals in the pipeline that you're delivering in 2027 or 2028.
Right.
But as a country, it's not helping address our housing affordability challenge that we have, right? I mean, certainly the federal government has come out with some initiatives, getting rid of GST for new home buyers. We're seeing some changes at the provincial level in Ontario and other provinces to try and foster new housing supply. The effect of those changes in housing policy take a while to work through to fruition. And so we really need to give those time to sort of help us. But cautiously optimistic that, the industry will be able to respond.
Can we give you the magic wand question?
Okay.
You wave the magic wand, say you're PM for a day or whatever. What 3 changes would you make policy-wise to solve the problem?
Well, I think we need to recognize that the federal government is but one level of regulatory sort of oversight that we have for the industry in Canada. I mean, importantly, the province and municipalities have a significant role in regulation, right? So the federal government has some tools, but they're not
Okay, let's call
omniscient.
you dictator for a day.
Okay.
You are the mayor, the premier, and the prime minister.
Well, so you raised Mark Kenney's name earlier, and I one of his quotes, I love it. We need to stop taxing housing like we tax cigarettes.
Yeah.
I think it's a great quote, and it's so emblematic of the problem that we have. Between development charges and other levies, and then the GST, of course, we in some cases, you were looking at, sort of 6-figure levies on a per unit basis for housing. And so that to me is just absolute insanity, right? I mean, we're trying to foster more supply of something. Why would we tax it at that level?
Exactly.
And part of the challenge there, I know we've talked about GST, and certainly the government has made a lot of changes in that direction, particularly for first-time home buyers and for purpose-built rental. But I think there's more that could be done. Like, could we expand the GST relief for all home buyers, not just first-time home buyers? Certainly that would be great. Also, the way that the federal government has brought it in, it's $1 million, and then between $1 million and 1.5, it sort of is graded down. It's a massive housing market, right? This is a national policy for a national housing market. You look at housing prices in PEI versus Toronto or Vancouver, or let's say Winnipeg versus Toronto. $1 million buys you something quite a bit different in Charlottetown than it does in the beaches. So we maybe need to think a little bit about, could we moderate or modulate that policy a little bit as well? We talked about development charges. Certainly the federal Liberals election platform spoke about development charges and finding a way to abate those. Are there ways that we can mitigate that? Can they help provinces keep provinces or municipalities whole from a development charge perspective? I think that we need to look at how we fund infrastructure. Certainly, a lot of the infrastructure we have in Canada dates from the 60s and 70s, and it's crumbling, and it's probably not at the capacity level we need it to be because the country's grown so significantly. And we're putting a lot of that burden on home purchasers of new homes.
Yeah.
And the philosophy being growth pays for growth. It sounds great, but the reality is it's causing a real crunch in affordability. That's, I think, risks becoming a societal issue as young people have a harder and harder time affording a home. And what implications does that have on, our society? And I think we need to...
Can't go on forever.
No, it can't. And I think we need to really look at how we're funding infrastructure. So that would be probably point number 2. And I think we need to think about capital market conditions. Real estate and housing is incredibly capital intensive. We need to think about ways that we can make the sector more attractive for housing, more attractive for capital for housing, sorry. And so initiatives or policies like barring foreigners from purchasing residential real estate probably had a chilling effect, shall we say, on attracting foreign capital. If you want to attract foreign direct investment into a sector, barring them is probably, not the way to do it. So are there ways that we can attract foreign capital to the housing sector, which we need to get things built, and yet still prevent some of the, perceived abuses that maybe... I actually am not a believer that foreigners were buying great swaths of housing and just leaving them dark. I think they were typically coming in, they were buying pre-construction condos with the intent of renting them to residents. With the ban on foreign purchasers, that really took a significant chunk of that pre-sale or pre-construction condo market away. Yeah. And as a consequence, because those weren't there, developers weren't able to get to their pre-sale requirement to finance the start of a new building. And so that would be point number 3. Could we do changes either to policy from a foreign capital or taxation or other things that would make it a more hospitable environment for capital to invest in housing? Yeah,
those are great points. Speaking, you mentioned young people. One of the young killers at Colliers, future superstar, Nicolina on our team. She helps with a lot of the stuff we do around here in addition to her regular job. Do you have any questions for Michael? Do you have a question for him? Putting you on the spot.
Dayma and Garret mentioned how a lot of young individuals listen to this podcast, myself included. This is actually how I got my job at Colliers, by listening to one of their episodes. For young individuals, entering the workforce, I think so many people are in this euphoric state, a state of utopia of, I want to become a CEO, I want to own, I want to, be a top broker, whatever it might be. Once they kind of enter that hamster wheel, life gets in the way. Can you talk about, maybe we're entering the Gandhi state segment of this episode now, but can you share some wisdom as to how you, really kept that mindset and really allowed yourself to kind of move up the hierarchy and, get into the C-suite so young individuals aren't, swallowed up by the cubicle-shaped abyss?
It's a great question. I will say, I'll speak from my perspective. I would not consider myself an entrepreneur. There are lots of entrepreneurs out there, and I'm not one of them. I give full credit to entrepreneurs. They take a huge amount of risk to start their own thing, and I give them tremendous credit. I probably didn't have the courage to take on what they've taken on, and so I'm gonna leave that aside. I'm gonna speak about kind of I'll say more of a corporate career path, which is the path that I followed, and I don't think I necessarily went out with a design that I wanted to be the CEO of Minto. When I was 23, I had never heard of Mento. But because I didn't really know what I wanted to do. And so the approach that I took, though, was to invest in roles and in education that would open doors, that would provide optionality for me. Partly because I didn't know what I wanted to do. I've always thought that the people who knew in high school or university exactly the career path they wanted to go on and were committed to it from the age of 18 were the lucky ones. I didn't have that fortune. I was mostly muddled and confused through university. So, it's still confused, still muddled. But what I did in the early stage of my career, I think it was I invested in roles or education where I knew it would create optionality. And I think with that comes opportunity. As you invest in those roles, and by invest, I mean sometimes taking on a job that is a little harder work and maybe not as well paid and maybe not as glamorous, but does provide that foundational level of technical expertise and experience that is so important, and where you get to work with great mentors. Because most of the stuff you learn is not what you learn in the book. It's what you watch your more experienced colleagues or bosses do. And I was very, very fortunate through that process. And I would say, quite aggressive in making sure that I was looking for roles where I was working with great mentors. And so I would really emphasize that for younger people, anxious to get ahead for sure, but recognize that making those investments early in your career in training and in those roles and in those mentor relationships is like the most important thing. If you do that well, it creates opportunity. And also recognizing that there will be false steps. You will take on a role or a mandate or work with a boss who is not absolutely fantastic. And sometimes you need to, adjust and change course. And that's okay. And that's normal. And I think everyone has to go through that. So those would be some of the nuggets I would offer for what it's worth.
Yeah.
Okay. I think we got to wrap this up. Do you have anything else? Anything, just the 20-second version, is there anything that you want our audience to pay attention to? Minto, something that Minto's working on, something that you're working on personally?
I would just leave the audience with the point that I'm very, very bullish about housing in the medium and long term. As a country, we are growing at a healthy rate, more than 1% a year, even with the changes to immigration policy. Mm-hmm. We have not been building anywhere close to the number of homes that we need to. Housing affordability is a significant problem. I think that there's political will at provincial and federal levels to make the policy changes that we need to make to deliver more supply that will help close that gap, which I think is important for us as an economy, as a society, to make housing less of a distraction, let's say, for young people.
Michael Waters, thank you so much. Thanks everybody for listening.
Cheers.